welcome back to the Financial Secrets Revealed podcast. Today I have a returning guest. Please welcome LJ from Allan Gray. How are you, LJ?
Amanda, I'm well. How are you?
Excellent. Very well. Thank you for collaborating with me again. I'm looking forward to it.
Oh, the last time was really fun. We should do this more often.
We should. So last time you were here to talk about contrarian investing in my series 3 of Meet the Experts. And today we're doing a collaboration to learn more about the Allan Gray funds. So can you please let us know a little bit about yourself, and congratulations on your 20th anniversary with Allan Gray. I'm sure you've got a lot to share.
Right. Well, thanks. Thanks for that. Yeah. So first up, probably let's start at the start. Why I have this funny accent, right? Um, so Allan Gray, the man, started the business in 1973 in Cape Town.
It was a great year, by the way.
Oh yes, a great vintage. Yeah. So in '73 he started it in Cape Town. Prior to that, he ran money in America, and he did his MBA through Harvard. But he wanted to go back and start his own firm and his own business. And as firms start, you run your own money and some friends and family. And then the business grew as he got a longer track record. In 1989, exchange controls relaxed in South Africa. And remember, I say relaxed because, well, it's still alive and well in South Africa. You still can't take all your hard-earned rands and just invest it offshore. There is a little bit of restriction still around there. But in '89, it relaxed, and he saw this as another business opportunity, and he saw it as running some money for his clients offshore. And so he moved to London and subsequently to Bermuda and started our offshore business called Orbis. And so Orbis is still alive and kicking and doing really well. And then in 2005, we opened up our Australian business. And that's kind of like the history of the Allan Gray firms. I would call them the Allan Gray firms because we're all 3 distinct businesses: the South African business, the Australian business, and the global business, the Orbis business, head office out of Bermuda today.
Now, I was very lucky that you gave me a tour many years ago. I think it must have been 2014, down on the V&A waterfront, the beautiful Allan Gray building. Is that still there now?
It is, yeah. It's I would encourage anybody that hasn't traveled to Cape Town to please go and have a look. Cape Town is a wonderful, wonderful city.
Spectacularly beautiful, that's for sure.
Yeah, and the South African business still has the big head office down in Cape Town, and as I understand it, it's more than 1,500 people working for the business out there. In Australia, we're a lot smaller.
And make sure you treat yourself to a great seafood lunch on the V&A waterfront when you finish the tour.
Absolutely, yes. Yeah, and some good South African white wines there with your seafood platter.
That was my next recommendation. Hit the local wines as well.
Yeah, exactly.
Beautiful.
Yeah.
Now, you are known for being contrarian investors. Is this part of your core investment philosophy, and how does it work?
Absolutely, yes, yeah. Our the string that runs through the 3 businesses would be our investment philosophy. That is being contrarian, and so you'll see some of the taglines: invest differently, contrarian investing. And so forth. But it's only one part of 3 parts of our investment philosophy. The one is being contrarian. So we find our best ideas there where other people fear to tread. They don't want to look there because, well, either the industry is done really poorly or the stock is underperformed for a little bit. And when people say, hey, just sell this share, and I don't want to explain to my clients why we're owning it. To us, that's irrational. And so that's a good place to start to look to buy shares. The second pillar of our investment philosophy is fundamental. So that means we do all our own work. in terms of going and looking at these shares or securities that are selling for, well, in our view, below what they should be trading at. Uh, and really doing the hard work. Is there something fundamentally wrong with this business, that this business has been impaired for the next few years, or is it just a short-term thing that has driven the share price or the asset price down? And if it's a short-term thing, then we would look at it and start purchasing that asset. And then the third thing is long-term. We don't try and look at what happens over the next 6 months, over the next 18 months. We really look at owning this asset for the next 4 to 7 years. And if we believe something would trade back up to what it's really worth, then we'll start buying that. And so you can look at our investment philosophy as these three pillars, and it's almost like a chair that you sit on with three legs. If one of those legs gets taken away, you're going to fall over. For example, if you're just fundamental and long term, well, you look like everyone else, and you probably need to just buy the index, and you'll do a lot better. You don't have to pay fees for that. If you're just contrarian and long term, if things start underperforming, you don't have the conviction because you didn't do the work yourself to actually stay the course in that share. And then lastly, if you're just contrarian and fundamental, you'll probably not be able to call what's going to happen in the next 6 months or the next 12 months. It typically doesn't work out in the very short run. So we do believe those three pillars of our investment philosophy is very core, and being contrarian and long-term fundamental managers, it might mean you're wrong for quite a period of time. So you're the only person owning a asset that everybody else says, you're crazy, why are you owning this thing? So it is a hard thing to do. It sounds simple, but I think it's a hard thing to do. If you do it that way, over the long run, we've added value for clients wherever we've deployed that strategy. And I think one of the big things is human emotions are the same no matter what language you speak or culture you're in. We overreact on the downside and on the upside. And so that gives us the opportunity to buy assets at less than what they're really worth.
So we know we've got many people just look at the index funds that very basic, they track an index. You've got these three philosophies. How does that mean your funds differ from other mainstream fund offerings that we have in Australia that are looking at, you've got the equity fund and you've got a balanced fund? How do you differ from others of the big guys out there who offer similar sort of investments?
Yeah, I think the one thing is that we start with a blank sheet of paper. So we don't start with the index and then we say, well, we should upweight or downweight it a little bit. We start with, well, for the next 4 to 7 years, if we start purchasing an asset, what is the good things to own for our clients? What are the things that are trading well below what they're really worth? And we build our portfolios just in terms of that. So we start with a blank sheet of paper. We don't look at the index and say, hey, should I own the index or should I not own the index? It starts all fresh. We do our own work, and then we purchase a portfolio of companies that our clients should do well for our clients over the next 4 to 7 years. So it's very much longer term thinking. I think the differentiation really is between us and other parts of the industry is that we are not forced to own. For example, CBA is a very big portion of the index right now. So we're not forced to own any of CBA. And guess what? Today we think CBA is probably a little bit expensive. So we're not saying it's a bad company. We're not saying that it's going to fall over tomorrow by not owning any of it. We just think that the price that you pay today for CBA is too much. And so we prefer not to own that. And so we don't have to. And so we don't. We buy shares or securities that we believe is trading at well below what it should be trading at. And we don't have to look at the index and say, well, CBA or is 10% of the index. We have to own some of it. If we don't believe it's worth 10 or should be in your portfolio, we just don't own it.
Which is, going really against the grain and mainstream investing. So that's a real point of differentiation for Allan Gray to, I suppose, be brave enough or silly enough when there's people on the other side
Yeah.
going, "You guys are nuts."
Absolutely, and I mean, it sounds sometimes silly, and it probably is. I mean, um, in investing, you need to get 60% of your calls right to do a really good job for your client, and that's probably our long-term average of the calls that we get right. Now, right and wrong is different. Right doesn't mean we do 10 times what the index has done, and wrong doesn't mean it goes to zero. It just means we've underperformed the index by a little bit, or we've outperformed the index. But if you hire a manager like us, you expect us to, over the long run, deliver you outcome better than that of the index. Now, I don't know about you, but that's like a really funny way of looking at the world, right? In terms of probabilities. If I go to the doctor, for example, and the doctor says, well, hey, 6 out of 10 of my patients that walk out here walk out alive, I'm not going back to that doctor.
You
But
just told me it was good odds, LJ. Come on.
yeah, well, it depends on what's wrong with you, right? But uh, but but just a sniffle or a cold, and he says, well, 6 out of 10 survives. You're going to say no, thank you. Whereas the 6 out of 10 is really, really good for in the funds management business, right? So uh, with that, you can over time build up a really good result for your clients, eking out 1 or 2% above that of the index. You've done a great job for your clients.
So, where would it sit in somebody's portfolio? Is this
Yeah.
something you would use as a core strategy in your Australian equities, or if you're looking at global, your global area, international funds, or is this more like a core and a satellite? How do you position the Allan Gray funds for investors?
Yeah, so it's very difficult not to go into personal financial advice here, and I would absolutely
Stick with
recommend.
general, LJ.
Yes, I would actually absolutely recommend people to go and see a financial planner or professional to actually
So work
put
out
it
what's
within
best
the
suited for you.
exactly, yeah.
Okay.
But the big thing that we do is on the Allan Gray side, we've got three funds. We've got an equity fund, we've got a balance fund, and we have a stable fund, and they all have different risk profiles. And then on the international side, we do have our global equity fund, and recently we've brought our emerging market strategy into the market here in Australia as well. And as I mentioned before, wherever we deploy our contrarian investment style, it has, over the long run, yielded results for our clients. So, so where do we fit in? Do we fit in as a core or a satellite? Again, it depends per individual and client. It's very hard to say this is exactly what we uh,
Exactly
this
where
is
we
the
fit.
percentage that you need to put in. Uh, but I think the big thing is that you can expect us not to look like the index. If you want an index-like return or result, it's better to pay nothing and go to, or when I say nothing, very little in index funds, um, and then you'll get market-like returns. Our job, or what we're trying to achieve, is better than index results, and that's the investment philosophy that we bring to the table.
And that's probably the same answer for the next question. In what type of investor is best for each of the funds? And that's again determined by your risk profile and discussions with your advisor, I'm guessing.
Absolutely, it definitely is. Um, I think your advisor would know what your risk tolerance is, what your current portfolio looks like, because it doesn't help doubling up on certain types of risks. You need to have a holistic view of your total portfolio in order to determine what's the best outcome for you. I think that the three portfolios, and you're probably going to discuss that with the portfolio managers as well. They have different mandates and different outcomes that they're trying to achieve. But we think that suite of funds is broad enough for a lot of clients to actually have a look at them and say, do they actually fit in my portfolio or not?
Now, I'm going to be doing deep dives into those three funds with the portfolio managers who also act as analysts, I believe, Simon and Suhas. So we've got the equity fund, the balanced fund, and the capital stable fund deep dives coming up. LJ, can I invite you back after we've done those three to do a bit of a wrap up and share some insights from what we've heard from those three guys?
Yeah, absolutely. Any day of the week, Amanda.
Excellent. So, in the meantime, if anyone wants to do a little bit more research or find out about Allan Gray, what's the best way to go about that? You've got a website, I'm guessing.
Absolutely, yes. It's Allan Gray. It's ALLANGRAY.com.au. You can go there. All the information about Allan Gray. We even have some information about our Orbis funds on the site that you can click through. If you just want to have a look at the Orbis funds, you can go to orbis.com.au as well, and you'll find our international funds in there.
Excellent. Or reach out to your advisor who may know a little bit about them anyway. So, excellent. Thank you for sharing that, LJ. And we'll be back at the end to check in again.
Yeah, can't wait.